Hey everybody, Courtney Smith here with our September 26, 2022 edition of Wall Street Winners. All right, the market did exactly as I told you it would do last week. We've started to accelerate to the downside. You can see that we left a gap on Friday, heavier than normal volume, but not super heavy volume. What does that mean? It means we're going to continue to move lower, although there is one caveat, and I'll tell you that in just a second. This looks like when you see a market that is starting to accelerate to the downside on larger than normal volume, you know that it's going to continue to go lower. However, notice right here, we've got the RSI down to that 30 level, which in the past has usually called for a small rally. So that's the caveat. I'm going to point it out on the other charts as well. But this is plunge-o-rama. And when you get plunge-o-rama, it keeps on plunging-o-rama. Now, you may ask yourself, well, is this a crash? Probably not. Probably not. Crashes are rare, and they occur at the end of bear markets, and I don't think we're at the end of the bear market yet. So we'll hang on. Let's take a look here. You can see the same type of thing, the plunge-o-rama down here, but notice we broke below those previous lows here, making lower lows. Look at the extraordinary selling pressure here, the little red line. We're up at a level that's unsustainable. So look for a quick snapback rally early in the week, but then continuing lower later on. This rising black line is called ADX, and it's a strength of trend indicator. So it's saying, as it goes up, it's saying the bear market trend is getting stronger. How about the Nasdaq? Nasdaq didn't break those lows back over here, but same thing. Plunge-o-rama. We got down to the 30 level again. Once again, that's usually a good indication of a rally. And notice how we closed above the middle of the range. That's an indication that we're going to snap back up, but just for 2 or 3 days, that's all. And then I think we're going to go back to the plunge-o-rama. Notice the purple predictor is under the price action, whereas back up here, even back here, it was above the price action. So when it's above the price action, that's bullish. When it's below the price action, that's bearish. So this is another bearish indication. Seasonality, we're still neutral. We got to get here, seasonal bullish period, September 30th. Clearly it's a bear market, so we don't even have to worry about it. Utilities should be bullish, but they're breaking down. So technically bullish, but I can't buy Utes because they're in a bear market. And guess what? I never buy stocks in bear markets. I sell stocks in bear markets. Now our seasonality says we should continue to move lower here. Maybe a little bit of a rally, maybe even a little bit of a rally through November, and then plunge-o-rama. So you got the picture. We're going to see a lot of plunge-o-rama here. Maybe make the low here at the end of October, and then the Fed may panic. The market may think that the Fed is going to panic, and that's good enough to get a bull market. Next year, I don't know if it's going to start here. We'll keep an eye on it for you, of course, week by week, because we're now at that phase where we're getting close to the end of the bear market, not close to the beginning. Keep that in mind. Let me repeat, we're closer to the end of the bear market than we are to the bull market. Now remember, I told you last year we would have a bear market. Now I'm telling you next year we're going to have a big bull market. The only question is when do we switch from the bear side to the bull side? Could be very soon. Probably in the next month, but we'll keep you posted. Don't worry. That's why you're here at Wall Street Winners instead of all the other garbagey guys that don't know anything about anything. Okay, asset allocation. The money came out of the stock market. After getting money from the bond market, you can see over here, money came out of the bond market into stocks, and now they've given up the ghost. They're saying, you know what, forget it. We like bonds better. So, stock market risk indicator, as you might expect, they don't want any risk in the stock market. Stick with the slow-mo stocks rather than the sexy Nasdaq stocks. Global shares, plunge-o-rama. Have I said that before this week? I think I have. These stocks are going to do worse than the U.S. stocks. Yield curve, got a little pop-up, no big deal. Look over here on the left-hand side. Except for the very beginning of the yield curve over here on the far left side, it's a negative yield curve basically all the way out. That means recession. That means bear market. But of course, it's been bearish now since last year. So, big reason why we told you this year would be a bull market. Now, it's not bullish. So this bear market should stay in force until we see the Fed start to ease monetary policy, or the market thinks it's about to ease monetary policy. This bear market will continue. Over here, bonds going down, but look at the purple predictor. What's happening is the smart money. This is called unbalanced volume. We call it the purple predictor, but whatever, unbalanced volume invented by Joe Granville, it's starting to bottom here. And that tells me that it looks like we may be reaching a bottom in the bond market because the smart money's buying bonds. They're just scared now. They're getting scared. And so we might start seeing even more money shift out of the stock market and into the bond market. Now that would cause the capitulation that I'm looking for in the stock market. Most bear markets end with capitulation. A crash is a type of capitulation. But bear markets usually end on capitulation. What is capitulation? Capitulation is where the longs, the bulls, they give up. They say, that's it, I give up. I can't stand the pain of losing money anymore. I give up. Guess what? That was the bottom in 2009. When everybody gave up, they panic sold. Bingo, that's the sign to buy it. We haven't seen that yet, so I'm not ready to buy. Bond key factors. Let's stop here for a second. We haven't talked about bonds for a month or so. So the green line that you see back here, it's skyrocketing up. And that's bond yields. And they're skyrocketing up. Now behind that, you see this blue line here. This blue line is 10-year treasuries in Germany. That's the biggest competitor. If an investor, global investor, wants to invest money, they usually go to the US first. They go to Germany second. But now, another interesting thing is happening. So you can see that the German 10-year yields are skyrocketing as well. So that pushes up US yields. But look behind this. Look at this chart here. It's breaking down. That's the CRB index. That's a leading indicator of bond yields. Down here, this is the price of gold. This gold line here, it's in a bear market as well, suggesting we're going to see a bull market in bonds. Now this is basically a 6-month leading indicator. So it really turned negative in my mind. Let's call it August, September. So early next year, say February, March, we should start seeing a major bull market in bonds. You heard it here first. Write down in your calendar, February 15th of next year, bond market, bull market. Just write it down now. Go ahead. See if I'm right or not. Guess what? I'll be right. You're never going to see this type of analysis anywhere in the world, which is why you're watching this video. Now, because bond yields are skyrocketing, it's really boosting the dollar. Of course, we've been telling you that for the whole year. Any chart that starts in the lower left and ends at the upper right, that's a major bull market. Got to be long, and I am long. But that means that gold has got to be down. So just ignore the doom and gloomers. Ignore the gold bugs. Those guys are morons. That's Mo for Mo, Ron for Ron. They're selling you newsletters and gold. They're not selling you how to make money. That's why you come to Wall Street Winners. Our indicators, this one's barely neutral. The other are obviously negative. Watch for gold to continue to go lower. We're here dedicated to making you money, not ideological foofara. This is another interesting chart to me. We saw crude oil break down. And I've been explaining the crude oil market for you, but the recession that's here, even though it isn't really in everybody's consciousness, it's starting to get in everybody's consciousness. That means demand for oil is going to drop. And then, of course, we're all going to move to California, where we can not plug in our electric vehicles, but we'll be forced to have electric vehicles. I'm still trying to figure that one out, but okay. Bitcoin slowly dribbling lower. We get under 20,000, then we get a little pop. Then we go below 20,000, we get a little pop. Purple predictor has turned bullish, so I don't want to do anything. I have a short position in Bitcoin right now, but this purple predictor makes me nervous. Fundamentally, it should go down to about 10,000 and then start a bull market. But here we are, drifting sideways. But major bear market, consolidation. The consolidations after a major bear market are usually broken to the downside. So I'm sticking with my short position in Bitcoin. Okay, freebies, you know what to do. Come on, don't hesitate. Sign up and become a fully paid up member. I want to tell you about a concept that we call extreme profits. I'll tell you what it's generically called in a second, but this is the most powerful risk management tool ever invented. Now, normally I use a technique, and what I teach in most of my courses is a technique called fixed fractional. And I teach that technique for a very simple reason. It's the best balance between a risk and reward, the best balance. But extreme profits, this technique is not about balance. It's about extreme profits. So it's kind of insane, but it does lead, it can, if you do it right, you have to do it right. So there is a caveat there. You have to do it right, and then it becomes the most profitable system ever. Now, this is based on research by John Kelly, who was a Bell Labs scientist, and it was perfected by my friend Ed Thorpe, who was the guy who really popularized card counting in blackjack. And it's called the Kelly formula. You can Google it and you can learn quite a bit about it online. And what the Kelly formula does, though, is it's not designed for this balance between risk and reward. It's designed to maximize profitability. Maximize profitability. So it turns risk management from a defensive weapon into an offensive weapon that you can wield to maximize profitability. Well, it's, nothing is for free. So the bad news with this technique is that there's much higher equity volatility. If you did it the way Kelly and Thorpe used it, you could see your account drop 50% in one day. Now, that's not the way I use it. I've completely modified it so that it's far more relaxed. Still higher equity volatility than I'd normally have and what I normally teach, but much less than the way it's taught by John Kelly, Ed Thorpe, etc. The good news, if done correctly, it can lead to dramatically higher profits. I said a second ago that you could lose 50% in one day. Yeah, but you could also double your account in a day as well. So, as you can see, it's dramatic in both directions, but do it correctly. Now, the Kelly formula was actually invented for as a formula, John Kelly, to how to get more information to go through a copper wire. He worked for Bell Labs, and so they were trying to figure out how to get more information to go through a copper wire. But then guys like Ed Thorpe and other mathematicians came along and realized that it could be used for gambling and it could be used for investing. And Ed Thorpe built a tremendous career as an investor. I wouldn't even say he was all that good of an investor, but he used the Kelly formula better than anybody I've ever seen. So that's what it's all about. Now, hang on. See, I'm going too fast. I'm too excited. So how can you get this? We've put together a course on extreme profits. I used many years ago. I did a course quite often. It was a $5,000 course, and we did it on futures and Forex, and it was incredible. I mean, it was just an incredible course that cost $5,000. Well, what we've done is we've now adapted this for stock traders. This is amazing. Nobody's ever taught anything like this ever. Now, in order to get this, you have to join the Wealth Builder Insider Membership Program. And that's a modestly priced monthly membership program. I'll show you the URL in just a second here, and you can click on it. But you get this course, which we're posting pieces of it every day now, on the website. And you get that, but then you get the most extensive education on stock and option trading in the world. This membership site Well, I'll be frank with you. The problem with it is that there's too much. You get too much. So we even had to add a section on how to actually attack the website, because it's going to teach you asset allocation, stock selection, swing trading, position trading, multiple techniques for stock selection, ETF trading, everything. It's really, quite frankly, a bit overwhelming. So the very first section, which we call the hub, tells you how to attack it in a logical manner, depending on what you're most interested in. And of course, we also have options trading on there as well. And that's all for one low monthly price. This is like getting 10 PhDs for a peanut. So where can you get this? Well, it's pretty simple. You just go to wealthbuilderinsider.com. wealthbuilderinsider.com. You don't need the capitals, but I just made it capital so you can read it easier. But go there, check it out. Remember that what's not on this website here is we've just added our Extreme Profits for Stocks course inside the Wealth Builder Insider. All right, everybody, go there now. I'll see you inside.